Imagine a world where money works for you while you sleep. Welcome to the world of high-yield dividend ETFs. In this fascinating world of finance and investment, one of the most intriguing concepts is that of passive income, the idea of earning money without active involvement or labor. One such avenue of generating passive income is through high-yield dividend ETFs. But what exactly are these, you may wonder? Well, let's break it down. ETFs, or exchange-traded funds, are investment funds traded on stock exchanges. They are designed to track the performance of a specific index, sector, commodity, or asset. Now, when we talk about high-yield dividend ETFs, we're referring to a specific type of ETF that primarily invests in stocks with a history of paying high dividends. The dividends these ETFs pay out can be a lucrative source of passive income. Suppose you are an investor who owns shares in a high-yield dividend ETF. In that case, you'll receive a share of the profits, or dividends, that the ETF earns from the stocks it holds. These dividends can be reinvested back into the ETF or taken as cash, providing a steady stream of income without the need for selling any of your holdings. In addition to the potential for regular income, high-yield dividend ETFs offer a couple of other enticing benefits. They provide a way to diversify your portfolio because each ETF holds a variety of different stocks. They also offer an opportunity to invest in well-established profitable companies that have a history of paying reliable dividends. But like any investment, high-yield dividend ETFs also come with risks. The dividend payments are not guaranteed and can fluctuate based on the performance of the underlying stocks. And of course, the value of the ETF itself can go up or down. So are you ready to dive deeper into this fascinating world? Great! Buckle up and let's begin. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. So, you might be wondering, what exactly is a high-yield dividend ETF? Well, let's dive right in. ETF stands for Exchange Traded Fund. These are investment funds traded on stock exchanges, much like individual stocks. High-yield dividend ETFs are a specific type of ETF that invests in stocks that pay high dividends. Now you may ask, what's so special about dividends? Dividends are a portion of a company's profit that is distributed to its shareholders. When a company is doing well and generating profits, it may decide to share a piece of the pie with its shareholders. This is where the term dividend comes from. It's basically your share of the company's success. A high-yield dividend ETF collects these dividends from a broad range of companies and distributes them to the ETF's shareholders. Sounds appealing, right? It gets even better. These ETFs often focus on companies that have a history of consistently paying high dividends, which can provide a steady stream of income for investors. But why should you consider investing in high-yield dividend ETFs? Well, there are several reasons. First, they provide a potential source of regular income, which is especially attractive for those seeking to generate passive income. Second, they offer diversification. Instead of having to select and manage individual high dividend paying stocks, you can invest in a wide range of such stocks through a single ETF. It's like putting your eggs in different baskets, reducing the risk. And lastly, high-yield dividend ETFs tend to be less volatile than growth stocks, which means they could provide some stability to your portfolio in turbulent times. Remember though, that while they offer potential benefits, like any investment, they also come with risks. It's crucial to do your research before investing. Now that we have a basic understanding of high-yield dividend ETFs, let's move on to some specific ones you might want to consider. First on our list is the SCHD, or Schwab US Dividend Equity ETF. Now what exactly is SCHD? It's an exchange-traded fund that seeks to track the performance of the Dow Jones US Dividend 100 Index. This index is composed of high dividend-yielding US stocks. And the best part? SCHD specifically targets companies that have a record of consistently paying out dividends. This makes it a reliable source of passive income. Let's delve into its performance history. Since its inception in 2011, SCHD has consistently outperformed the broader market. In the past 5 years alone, it has seen an average annual return of over 7%. That's impressive. Now, onto its dividend yield. As of the end of 2024, SCHD boasted a dividend yield of around 3.3%. This means that for every $100 invested in the fund, you could expect to receive about $3.30 in dividends each year. Not a bad return, right? But why is SCHD a good option for passive income? Well, it's all about stability and consistency. SCHD's focus on high-yielding, dividend-paying stocks means that it provides a steady stream of income, even during market downturns. Plus, its diversified portfolio of established companies reduces risk, making it a safe bet for those looking to generate passive income. Moreover, SCHD's low expense ratio makes it an attractive option. With an expense ratio of just 0.06%, it's one of the most cost-effective ways to invest in a diversified portfolio of high-yielding dividend stocks. To sum it up, SCHD offers an attractive combination of high dividend yield, consistent performance, and low costs. It's a fantastic way to generate a steady stream of passive income without having to constantly monitor your investments. SCHD is a strong contender for those seeking reliable income. Next, let's look at another option. Next up, we have the JEPI, or JP Morgan Equity Premium Income ETF. Now, JEPI is a bit of a unique player in the world of high-yield dividend ETFs. It's a relatively new fund, having been launched in the middle of 2020. But don't let its youth fool you. It's already making notable waves in the financial seas. JEPI's approach differs from the traditional high dividend yield ETFs. It aims to provide a monthly income stream from the option premium generated by an options trading strategy, in addition to the dividends from its equity investments. This dual income stream makes JEPI a compelling option for income seekers. In terms of its portfolio, JEPI primarily invests in large-cap U.S. equities. As of the end of 2024, it held over 200 stocks, with a heavy bias towards the technology, healthcare, and consumer discretionary sectors. This diversification provides a level of protection against market volatility, and it's one of the many reasons why JEPI stands out. Now let's talk numbers. Since its inception, JEPI's performance has been impressive. It has generated a return of around 6%. But what really matters for income seekers is the dividend yield. JEPI has a yield of around 7.7%, which is significantly higher than many other ETFs in the market. But it's not just about the numbers. JEPI's strategy of generating income through both dividends and option premiums gives it a unique edge. This dual income approach can provide a steady cash flow, even in volatile market conditions. This makes it a potentially good fit for those looking to generate a passive income. However, it's important to note that, like all investments, JEPI comes with risks. The fund's reliance on options trading means it could be affected by fluctuations in the options market. So, it's crucial to thoroughly research and consider your own risk tolerance before investing. JEPI is another great option for those seeking to generate passive income. But before we wrap up, let's look at some important considerations. Before you dive into the world of high-yield dividend ETFs, there are some important considerations to keep in mind. Now let's talk about these considerations. First up is diversification. Diversification is not just a fancy financial term, it's a strategy to balance risk. It's about spreading your investments across a variety of assets to reduce the potential for loss. In the context of high-yield dividend ETFs like SCHD and JEPI, diversification means not putting all your eggs in one basket, or in this case, not investing all your money in one ETF or one type of ETF. There are numerous ETFs out there, each with its own unique focus, management style, and risk level. So ensure your portfolio is well diversified. Next, understanding your own risk tolerance. Risk tolerance is personal. It's about how much risk you're willing to take on in exchange for the potential for higher returns. Some people are thrill seekers, ready to invest in high-risk, high-reward assets. Others prefer a slow and steady approach, opting for lower-risk investments. When considering high-yield dividend ETFs, remember, higher yields often come with higher risks. Make sure you're comfortable with the level of risk associated with your chosen ETFs. Finally, the need for regular portfolio review. Investing is not a set-it-and-forget-it game. It requires regular check-ins. The market is dynamic, constantly shifting and changing. What worked well one year might not the next. Regularly reviewing your portfolio allows you to make necessary adjustments, ensuring your investments continue to align with your financial goals. So, there you have it. The 3 crucial considerations before venturing into the world of high-yield dividend ETFs. Diversification, understanding your risk tolerance, and regular portfolio review. Keep these in mind, and you'll be well on your way to making informed and successful investment decisions. Investing is not a one-size-fits-all solution. It's important to understand your own financial goals and risk tolerance. And remember, the journey to financial freedom is a marathon, not a sprint. Take your time, do your research, and make wise decisions. Your future self will thank you. So, there you have it. A quick guide to high-yield dividend ETFs and how they can help generate passive income. We've taken a journey through the world of passive income and how high-yield dividend ETFs, specifically SCHD and JEPI, can play a significant role in your financial strategy. Let's do a little recap, shall we? We started off by understanding what high-yield dividend ETFs are and how they can be a source of regular income without requiring you to sell your investment. We then moved on to discussing the specifics of SCHD and JEPI, two ETFs that have shown promising results in the past. Remember, SCHD focuses on high dividend-yielding U.S. companies, providing a balance between income and growth. On the other hand, JEPI aims to provide enhanced income with the potential for capital appreciation, an attractive proposition for those looking for a mix of growth and income. In our important consideration section, we stressed the importance of not just jumping in, but taking time to do your own research, understanding the risks involved, and making sure that these investments align with your financial goals and risk tolerance. Remember, every investment comes with its own set of risks and potential rewards. Now, while we've done our best to provide a comprehensive overview, this video is not a substitute for professional financial advice. It's always a good idea to consult with a financial advisor who understands your individual circumstances before making any investment decisions. We hope this video has provided some valuable insights into the world of high-yield dividend ETFs and sparked your interest in exploring this further. Remember, the goal is not just to make money, but to make your money work harder for you. Before we wrap up, don't forget to subscribe, like, and share this video. Stay tuned for more content on making your money work harder for you. Until next time, keep investing and keep growing.